Over the last few years, I've been fortunate enough to build up a double-digit property portfolio. During this period, I've had to develop my own knowledge and navigate through a whole host of challenges and mistakes. But the reality is, if I can do it, then so can you. This Property Market Investor Real Investor Success Series has been created so that everyday Australian investors can share their investing stories to the benefit of those looking to grow their own investing knowledge. Today, I'll be meeting with Eddie Dilleen, who has built up a 16 property portfolio all in less than 10 years' time. Eddie's story is quite unique and is off the back of some serious hard yards, including working multiple jobs to get those initial property purchases across the line. Let's join Eddie and find out more about his inspirational investing story. Hey Eddie, how's it going?
Really good, mate. How are you?
Yeah, pretty good, thank you, pal. So take us right back to the beginning. What was it that first got you into property?
Yeah, sure. So I think I first became interested in property as a teenager, really. I grew up in Western Sydney, about probably an hour out of the heart of Sydney. And you know, coming from a family, it was very humble beginnings, basically. Like no one in my family owned a property at all. So over the years, pretty much from when I was a teenager, that was my kind of driving factor. When I was about 16 years old, I realized that no one in my family owned property, and if I wanted to really generate, and create wealth over time, and I would have to get into property as soon as I could. I don't have to really do something different compared to what everyone else was doing.
Yeah, indeed. So what was it that actually opened you up to see that property was an opportunity? Did you know somebody? Was there a distant family member that happened to be doing quite well?
Not at all, really. It was kind of the opposite. Like everyone where I grew up was very rough neighborhood, and it was very kind of underprivileged kind of area. So it was just really taking that from that kind of environment, that kind of atmosphere where there was a lot of struggle, there was a lot of pain, there was a lot of tension in the family with that no money. Like grew up on housing commission.
Wow.
Grew up with a single mother as well who was on a pension, so no one in my family was working at all. So even just for someone looking on the outside, just having a normal job was not a normal thing for me.
Wow. So you wanted to take that to the nth degree of I suppose, achievement.
100%. So, I realized that in the future when this is like 16, 17 at the time when I was looking forward, I was like, when I'm, 25, 35, 40, etc., I do not want to have this to be in the same situation. Yeah. I don't want to have to be worried about money and struggling and have my kids in the same kind of environment and that kind of really rough neighborhood as well. So that's when I first started doing research about how people do make money, how they do create wealth, how they invest in property. And that's when I started reading property investment books and trying to find stuff out. There was no one out there that I knew, but I was just and I hated reading at the time because I wasn't good at school at all either. A very rough school. Hated reading, but I was like, I'm going to have to do this and read property investment books to build up that knowledge and that education. Start off with books like Rich Dad Poor Dad as well.
Indeed.
So, yeah.
And then did it take, so you found that property might be the vehicle in which to change your situation and put yourself in a prosperous position. How long from taking that decision did it take to purchase that first property?
Probably about 2 years roughly. I had my first job, I was working at McDonald's at the same time I was in high school, so I was about 14 when I started working, but I was still in high school. And back then, coming from the neighborhood, I didn't even know what uni was. That's how how crazy the area I kind of grew up in. And started working at the age of 14 at McDonald's. Worked there for about 2, 3, 4 years. And I made that decision at say 16 to really start saving towards that deposit. So from 16 to 18, I was putting away, a couple $100 a week, as much as I could, working while going to school. And then at 18, between 16 and 18, did more research, read more books, looked on realestate.com and all that kind of stuff. Started, trying to figure out how I can buy property. And that when I was 18, I bought my first one.
I see. And where was that first property and what was the purchase price?
The first one was in the Central Coast, so that was around the Wyong kind of region. Purchase price of that one was $138,000. So super cheap, affordable. My borrowing capacity was $140 at the time.
So you went right to the top of what you could get. And did you put down a 10, 12, 20% deposit? How did you finance that?
That one was a 10% deposit, so it was about 13,000 roughly plus stamp duty. All that stuff came from about 20 grand. Yeah.
Lovely stuff. And even at that stage of making that initial purchase, did you know that you wanted to build something larger, so an actual portfolio rather than just the one?
A little bit. I thought then maybe have 2 or 3 properties.
Yeah.
But I didn't think getting to like 16. At 27, that wasn't my goal at that stage. I had that more old school mentality where I'd buy 1 or 2 or 3 and then just pay them off as soon as possible.
Yeah, fair enough. Yeah.
So that's what I first thought, and then I remember like writing down and books and on bits of piece of paper, like how long will it take me to pay these off? Pay 1 or 2 or 3 off, and then I was like, what will that give me an income when I'm 25? And then I realized that wasn't going to work. I'd have to leverage more to build something bigger.
To get there. So was you working out at that stage the annual income from the property minus the operating costs like management fees, insurances and stuff with you? So it leaves you with your net income that you've got. And then at that stage you realise, you know what, I need quite a few.
That's right.
Yeah.
That's exactly right. I was like, even without loans on them, if I have 2 or 3 and they're rented out for like $300 a week, $400, I'm like, well, that's still not going to be quite enough.
Yeah.
And it's going to take me a long time just to pay them off, the normal way.
So why settle for something that's mediocre?
Yeah.
So you got property number 1 on the Central Coast.
Yes.
How did you then leverage to get into property number 2?
Yeah. Property number 2, it was probably my biggest mistake of waiting about 1.5 years, maybe 2 years. I didn't really do anything after that. I was 18, I just kind of went off and partied. But I kept saving after that. So I saved up another 10% deposit roughly. But coming to purchase number 2, that was a 3-bedroom house in Adelaide.
Yeah.
I did use half savings, half equity, even though I could have used all the savings, but yeah.
Okay, cool. What area of Adelaide is that?
That was in the Salisbury area, so it was north of Adelaide, probably about 25 minutes, not as far up.
I've got a couple of properties in, Evanston Park.
Yeah. Oh, beautiful.
That was my first property purchase, actually.
Oh, really?
Yeah. So, my understanding of that market is maybe it's a lower social demographic. As a result, you get better yields. And some of the properties around there have development potential also.
Absolutely, and like for me, I grew up in Mount Druitt in Western Sydney, so very like similar kind of suburb. For me, I was like, oh, that doesn't seem all too bad. But now looking at it, I'm like, oh yeah, I can kind of see whether what people say. But a lot of the people don't realise those areas, and like everyone told me, don't invest in Western Sydney and your Penriths and your Blacktowns and all that kind of stuff, but they've gone up ridiculous amounts. A lot of people have said don't buy there now. Like, you wish you bought there.
Too right, mate. Yeah. So you've got 2 properties now in the portfolio. Was it looks as though from those both also that the yield would have been pretty good. Was that a conscious decision at this stage? You wanted to find properties that you could leverage to purchase more, but also balance that yield?
That's exactly right. Like at the time, especially on my second property, like I was on a really low income.
Yeah.
So I realized that, if not from one aspect would be the borrowing aspect, would being able to continue having a borrowing capacity.
Yeah.
But I'd have the property take care of itself from an income expense point of view, because I didn't have much money to put towards it.
So it had to be, that was one of the key criteria of finding an opportunity.
100%, yeah. It'd always have to have like a really high rental return would be the main thing, but still kind of in a metro area as well.
Yeah.
So like I've known a lot of people that have bought in regional areas and that kind of stuff, because you get 7, 8, 9, 10% yields.
Indeed.
But then I've kind of realised that you can still get those kind of high yields in metro areas, but you just kind of look outside the box.
For sure. Do you have then a rule of thumb, or do you kind of calculate prior to purchasing, okay, this is the rental yield, you actually forecast what the outgoings will be, and then you're looking to at least break even after that pre-tax? Is that kind of the objective?
It is for sure, and definitely more so in the beginning stages. I would heavily focus on that.
Yeah.
Nowadays, not so much.
Yeah, okay.
If I buy something nowadays, if it's negative geared after all expenses by $20, $30, $40 a week, it's not the end of the world. Back then I thought it was. So I've become a bit more relaxed with the cash flow because I realise, you've got to have a balance of cash flow, growth, and for me, I want to buy below market value as well, or below comparable sales as much as possible to get equity inbuilt kind of thing.
Lovely stuff. So you're at 2 now?
Yes.
Got Central Coast, you got Salisbury in Adelaide. What was number 3?
Number 3 was a small unit. Again, that was about 25 minutes south of Brisbane.
Yeah, cool.
That one I picked up relatively cheap. Like this was about probably 2000. Can't even remember, 2013, 2015 roughly, or somewhere around that. And I picked up that unit for about 105,000, so that was extremely cheap. It was a 1-bedroom, it was very small, but the last sales were like 140, 150, 130, etc.
So how did you get it kind of so much below, what's that, maybe 30% below comparables? Was that, I don't know, maybe a distressed sale or something?
That definitely was. I think it's a combination of things. Like that one, I bought a lot of properties that are offline, off real estate and off domain. That one, funny enough, was actually on the market. But what I've learned over the years is that there's different caliber of real estate agents, like sales agents. Some have the fancy photos, some have the fancy marketing, some are like the no-name kind of ones, some are out of area. That can have a massive impact on what they even list the property for. That as well, based on how quick the owner needs to sell, is what I've realized is like time is money. So that particular owner, they need to sell within like 4 weeks. If they had 4 months, it would have been listed for 20% higher at the minimum. Plus the agent wasn't all there. So
okay. So you was able to understand that this is an opportunity, appreciate the value there, and take action pretty quickly.
100%, yeah.
Lovely.
That one was rented for about $220 per week. Which
we're talking like a 10% yield.
It's like 10, almost 11% yield, which I know they're small figures, but I'm like, that is, if you just magnify that by 10, that's ridiculous return. So like, I wish I bought more of those.
For sure. And how did you pay for the deposit for that one? Did you once again leverage, or was it again the case of working overtime to pay for a deposit out your own pocket?
The third one, that was pretty much savings, That one, I did a 20%, which 20% of 105 grand was nothing anyway. It was about 20 odd grand. But that was really the time after property number 3. I started working 2 jobs at a time. So I'd work full time during the day, and then I was a bartender at night.
And is this entirely for the purpose of, you kind of found something that was providing a good opportunity, you saw the light of that opportunity, and you wanted to grab it by both hands, so you were literally running as fast as you can to continue to acquire?
Definitely.
Definitely. It's like, addictive, right?
It really was. And I like to think that, think of things very logically. And I was like, realistically, I was probably like 22 or roughly around that age. I was like, I've probably got 5 good years before the kids and the things. The older you get, the more obstacles you got to overcome.
Serviceability might reduce.
So I was like, I've got to do this now. So that's when I really just like pedal to the metal and started working a lot of hours. And
lovely stuff. So 3 properties in. Did you, at any point in time, it sounds as though you listened to, as you said, the podcast and educated yourself. Did you ever go to any paid education courses that are available?
No, funny enough, I didn't. Like I might have went to like 1 seminar possibly by memory, but I did. It was mainly just doing a lot of research. By reading different property investment books. There wasn't many podcasts out there back then.
Indeed. And did you network, or did you try to hang around with like-minded investors?
Nowadays I do. Back then, unfortunately, I didn't, because like I was a lot more growing up from that kind of family and demographic. Like I was pretty shy in that aspect as well. I couldn't public speak. I couldn't do anything. It was like a totally different thing. So no, I didn't really. And everyone I knew at the time didn't own property, so I was all by myself.
Fair enough. Okay, cool. So what was number 4 in the portfolio?
Number 4 was a property in the Gold Coast, actually. That one, it was around the Surfers Paradise kind of area, and that's where everyone goes to schoolies and all that kind of stuff in Surfers Paradise. But that was a
Is that where you found the opportunity, through schoolies?
I didn't really find the opportunity, but I went there, and I was like, and then when I started really getting involved in property, I looked at the prices, like compared to like Western Sydney where I grew up. This is on the beach. This is a lot nicer, and it's a lot cheaper. So I was like, it can't hurt to diversify and get one here as well.
Indeed. So that was an intentional strategy, because by this point you've got a really diversified portfolio.
Yes.
So you moved to to the Gold Coast, and what sort of price range was that?
That one in particular, I wish I bought more of them. That was a unit, and I picked that up for 169,000.
Yeah, wow.
And that was renting at the time it wasn't rented, but I got that rented out right away afterwards for like $310 per week.
Oh, so once again, you're nailing those 10% yields.
There was like 9-10%, and this is like a metro Gold Coast area, blue chip quality location.
Walking to the boulevard and everything.
Yeah, it was like ridiculous, and there's different with those ones in particular. I've spoken to people recently, and you've got to be very careful because some of those, they're not classified as proper residential. They're like, if they're the high rises and they're the student accommodation, and then they.
What was the square meterage, the internal?
Internal, there was about, I think it was like 55 roughly square meters.
Yeah.
So it was
definitely a one better. Studio.
Yeah, so it was upwind finance. If you're anything under 40 or 50, it gets a lot difficult.
Yeah.
And then the prices are a little bit less but this one in particular was a lot bigger, and I knew it was much more valuable.
Indeed, yeah.
And the person who actually I bought that from, they bought it 5 years previous to that. They put a bunch of money into it, did like a $30,000-$40,000 renovation. They tried to flip it to make money. They just bought it too high to begin with when they bought it, and then they put money into it. And then I got that valued like at 30% higher, like 20 to 30% higher, like within 12 months.
After you purchased?
After I purchased it.
And was that part of the reason for purchasing that one as well? You saw that potentially it was built in with equity just based on comparables with maybe within that building?
100%. The last one that building sold for like 205, and that one I got for 169. Like that was probably one of my favourite ones.
So what mistake do you think the vendor had made? Had they maybe timed the market wrong? Maybe they purchased at the peak and then they were trying to offload at the downward stage of the cycle?
I'd definitely say so, yeah. And also, like, a lot of people get emotional with property, where it's like, if something's not for the right price, I'll just walk away. There's zero emotions involved. But as soon as someone goes there, they fall in love with it, and they're like, I'll buy it for a little bit more and all that kind of stuff. Whereas I'm not like that nowadays. So they definitely paid too much for it. Like, they didn't buy below comparable sales. They probably bought above comparable sales at the time when they bought it.
Yeah, wow.
Then they spent money on it as well. So
they had no idea. Were they a speculator then? Did they actually buy it for an investment purpose?
I'm not too sure, but I think they definitely did a big renovation on it. So I think they were trying to flip it and make money off of it. So that's why I haven't really I've done renovations, but I'm not a fan of like the selling, the flipping, unless it's for a particular purpose.
Have you sold any properties within your portfolio to date?
No, not at all.
No. Do you ever have intentions of doing so?
Maybe eventually, depending on thing, but I really want to just continue building it. And like the only reason why most people sell property is to either get the money out of it, or to be able to leverage into something else or whatever. But mainly, if it's to get the money out of it, I don't see the point, because I'd much rather leverage that money and release equity, draw on it. Not pay tax on it, and then just continue buying. So
number 4, how did you fund that deposit? Was it once again working?
Yeah, that one was a bit of both as well. So it was mainly, I was working very hard at that stage, and I put pretty much half savings, half equity into that one. Okay. Going back to the first two, the bank actually, I did use half savings but half equity, but the bank cross-collateralized them together.
Oh, the first two?
Yeah.
Wow.
And when I was buying number 4, I was like, then I started speaking with a couple of different mortgage brokers and different people. They're like, you've crossed it. And I was like, didn't even know what that means.
Exactly. They just suggest it to kind of lock you in, and you just say to get it done.
Definitely. So I had to, after number 4, I uncrossed them, and then I released equity from the first two.
Oh, fantastic. So that's after 4.
Yeah.
So you've cleaned up the portfolio a little bit from a lending perspective.
Yeah.
You've drawn out some funds and you're going shopping again.
Pretty much.
What markets were you looking at this stage?
That was after number 4. I'm trying to remember. I haven't had time.
Oh, it's tough, Right? You're going back probably, 5 years?
Yeah, something like that. So after that, I believe I bought another one in Adelaide, around the same kind of Salisbury area.
What made you want to go back to that market? Had you seen a good level of performance or opportunity within the existing property?
Definitely. Like I was comparing the two, the Brisbane and Adelaide. And if I were to do it again, I probably would have gone Brisbane.
Yeah.
But at that particular time, I was just shopping around, and that's when I bought my, I think it was second bank repossession. And that one was through an agent. It was offline. It wasn't listed online or anything like that. And that one, same again. Then I started really focusing on, as I did the second, third, the fourth, the comparable sales. The first one, I didn't really focus on comparable sales. It was just mainly what I could afford, but luckily I bought well. But that's when I bought that bank repossession. It was like, 30, 40 grand below
So did this almost turn into your strategy at this stage? It's looking at comparable sales, locking in an amount of equity almost, which is your security within the deal.
Yes, 100%. That's when I really started to focus on the below market value, below comparable sales.
Okay. Now since then you've purchased an additional 12, so you're up to 16 now. And throughout that, obviously we can't, unfortunately, today we're not going to do a 12-hour interview to go through every single, because you've got so many in the portfolio now. Did each of those follow that same strategy? Now that by 4 and 5 you've crystallised kind of the opportunity, did each of those subsequent properties follow that strategy?
100%, like that's always the three main factors that I mainly stick to is the below market or below comparable sales, the high rental yield, and then within a metro area. So like, as long as it ticks those three boxes, there's 1,000 other variables that people like to stick to. The vacancy rates, the demographic, the how nice it looks, and all this other kind of stuff. But those are the three things that mean the most to me.
Fantastic.
The three pillars, I guess.
Yeah, indeed. And because the portfolio is so large now, have you in recent times started to come up with more challenges on the finance side?
Definitely, yeah. At the moment, it's pretty hard to get finance. So, and plus I'm getting married soon, so it's like I'll probably be out of the game for maybe 6 months or so. But I don't want to get to 20. I'm like 4 away. I'm like, surely I can get to 20 soon.
And have these last couple of properties been quite challenging to get across the line with finance?
Yeah, for sure. Like one of the second last ones that I bought was a property around like Parramatta in Sydney, and that was a place for actually me and my partner to live in.
So that was principal place of residence. Nice.
And so that was the biggest one. So that one was definitely hard to get finance across the line.
Did you have to put down maybe a larger deposit then to help that?
It was I think it was 20% deposit by memory. I would have preferred to do a 10 or something like that. And this is right after New South Wales, like the whole stamp duty thing. So I paid stamp duty on pretty much every purchase I've ever bought as well. But that doesn't really matter.
Okay, lovely stuff. So the plan is now, it sounds as though you're going to settle down. You're getting married, which is good news. You've got your principal place of residence. It's an addictive game, right? When you get into it and you see the results, you see the equity, you compare that to maybe your day job and what you're earning, and you can almost replicate, double that, triple that, depending on what your strategy is. Are you realistically, after coming back from the honeymoon, going to be able to calm down for a little bit?
Probably not. I'm going to try to calm down a little bit, but I think it's similar to you. So once you get results and you see you can replicate it and keep going, you just want to grow and grow and grow. And I'm pretty competitive by nature, so I definitely think I'm going to just keep going. I might have 100 properties or 200 or 300 or whatever it is. So. Yeah.
Now, you've got your own business.
Yes.
You've got your own buyer's agency.
Yep.
And I imagine that this replicates the strategy that you've so successfully put into practice over these last, is it maybe 9 years that you've been investing?
Just about, yeah. It's been 9 years, almost 10.
Indeed. So if somebody wants to get in contact with you and speak about kind of how they can potentially leverage your experience, how could they go about that?
Yeah, so I've got a couple of different websites that they can reach me at. So there's just my personal one, which is Eddie Dilleen property.com.au, or my business one, which is dilleenproperty.com.au.
Okay.
Or on Facebook or Instagram or whatever.
Great stuff. And when will you be back from the honeymoon? When are you talking? Maybe it's going to be a little while, eh?
It's going to be probably October when I'm back, roughly.
Yeah, okay.
But
Okay, lovely stuff. Well, thank you so much for coming on today, Eddie.
It's my pleasure. Thank you so much.
Okay, cheers.
Thank you.